Welcome to this technical and sentiment analysis for the Nifty 50, focusing on the upcoming session for July 9th, 2026. Today, we will dissect the significant market activity from July 8th and prepare you for the potential scenarios that may unfold tomorrow. Our goal is to give you a clear roadmap for your trading day, using professional-grade insights available on the Dhan trading platform. For the best trading experience and deep dive analytics like the ones we're using today, I highly recommend using Dhan. You can sign up using the referral code EJZZI96380 to get started. Now, let's look at the damage from the previous session. The session on July 8th was what we call a sharp trend day breakdown. The Nifty 50 closed at 23,882.05, representing a steep decline of 2.12%. Looking at the intraday price action, the market actually opened quite firm near 24,450. It spent the morning consolidating in a relatively tight range between 24,000 to 24,300. However, the afternoon session saw a violent breakdown. This wasn't a choppy reversal. It was a clean, one-directional move lower that caught many off guard. Notice how the candle body is large and has very small wicks, indicating that the bears were in total control from the moment the breakdown started until the closing bell. This price action suggests that the sell-off was not just a technical dip, but a significant shift in immediate market sentiment. To understand the depth of this move, we have to look beyond just the price. Market breadth tells us how many stocks are actually participating in the move. On July 8th, the breadth was near capitulation levels. We saw only 4 stocks advancing, against 45 declining. In the morning, about 30 stocks were in the green, but that collapsed by the close. This confirms the sell-off was broad-based, not just a few heavyweights dragging the index down. Simultaneously, the put-call ratio, or PCR, showed a massive intraday swing. It dropped from 1.20 all the way down to 0.61. This indicates a fast and aggressive shift toward bearish options positioning. When the PCR falls this quickly, it shows that traders are rushing to buy puts or unwinding call positions in a panic. Furthermore, max pain trailed down from 24,500 to 24,200. But the spot price fell even faster and closed below it. Usually, the price tries to pin near max pain, but the genuine selling pressure was so overwhelming that it broke that gravity entirely. This is a rare and powerful signal of bearish strength. Now, let's look at the battlefield through the lens of open interest. As price fell, the resistance wall moved down in tandem. For the upcoming July 14th expiry, the heaviest concentration of call open interest is now stacked at the 24,000 strike. In the options world, this represents a new battlefield where sellers are aggressively defending the territory. On the other hand, put open interest is building beneath at 23,900 to 23,800. This suggests that 24,000 is now the level to beat for any recovery. While this looks very bearish, we need to consider the retracement possibility. A 2% drop with 4 to 45 breadth is statistically extreme. We are technically oversold. History tells us that moves of this magnitude often trigger a relief bounce. This happens because short sellers start booking profits, called short covering, and bargain hunters step in. So our base case for July 9th is not a straight line down, but a two-stage process. A likely attempt at a relief bounce toward that 24,000 level before the market decides its next structural move. To navigate this bounce, we must use Fibonacci retracement levels anchored to the July 8th range, from the high of 24,450 to the low of 23,780. The first major hurdle is 24,053, which represents the 23.6% retracement. Notice how this aligns almost perfectly with our new call open interest wall. If the market manages to push past that, the 38.2% level at 24,151 acts as the next shallow bounce ceiling. On the downside, 23,780 is our immediate floor. However, the most critical level to watch is 23,565. This is the May swing low. A decisive close below this level would be a structural disaster. as it would effectively undo the entire recovery structure built throughout June and early July. Think of this as the line in the sand for the medium-term bulls. If this breaks, we are looking at much deeper extensions toward 23,100. Based on this data, we have 3 scenarios for July 9th. Scenario A is our base case, the relief bounce first. The trigger for this is a flat opening or an early dip that quickly recovers the 23,900 level. We expect a move toward the new 24,000 call wall. Tactically, you should treat this as a zone to sell into strength rather than a trend reversal, unless you see the advancing stocks significantly overtaking the decliners. For options traders, a bear call spread, selling the 24,000 call and buying the 24,100 call, is a smart way to monetize that resistance wall if the bounce stalls. However, if the bounce shows real legs and closes above 24,230 with improving breadth, we upgrade this from a mere bounce to a genuine reversal attempt. This is the scenario where the bulls start to regain their footing. Use Dhan trading platform with referral code EJZZZI96380 for analysis. Scenario B is the downside continuation, which we must be prepared for if the market shows no strength at the open. If Nifty opens below or slips under 23,780 and fails to reclaim it intraday, the downside move remains live. The next reference points are 23,622, followed by that critical 23,565 support. Remember, 23,565 is the ultimate line in the sand. A decisive break here isn't just a routine dip. It's a structural warning that the recovery of the past 2 months is failing. If you are looking for a contrarian long, only attempt it below 23,780 with very tight stops. This is a high-risk relief play, not a core position, so size your trades accordingly. If 23,565 breaks on high volume, the next targets are much lower at 23,366 and 23,110. Use the Dhan trading platform for the best experience. Use my referral code EJZZI96380 for analysis and trading. Finally, let's look at Scenario C, the bullish invalidation of the downtrend. This is the least likely but most impactful scenario. To trigger this, we need more than just a morning pop. We need a sustained move and a close above the 50 to 62 1.8% retracement zone. That's 24,230 to 24,309. Price alone isn't enough here. We need the advanced decline breadth to confirm that the whole market is buying in. Until this trigger prints, any strength below 24,230 should be treated as a corrective bounce within a broader down move rather than a new uptrend. One critical piece of information to check before tomorrow's open is the FII and DII data for July 8th. Heavy institutional selling by FIIs would confirm this was broad distribution, making Scenario B the continuation more likely after any brief bounce. If the institutional selling is muted, scenarios A or C become much more probable as the market flushes out sentiment. Use Dhan trading platform for best trading experience and analysis. Use referral code EJZZI96380. In conclusion, the session on July 8th was a genuine, broad-based breakdown, marked by capitulation-level breadth and an aggressive shift in sentiment. While the technicals are heavy, the extreme oversold readings suggest that a short-term relief bounce is the most balanced expectation for July 9th. We should target the 24,000 to 24,050 zone, but treat it tactically rather than trusting it as a full reversal. Keep a close eye on the 23,565 level. It remains the single most important pivot for the medium-term direction of the Nifty 50. For real-time tracking of these levels, the candlestick charts, and the PCR swings we discussed, make sure you are using the Dhan platform. It provides the speed and depth needed for this kind of analysis. Don't forget to use the referral code EJZZI96380 to set up your account. Trade responsibly, watch your position sizes, and I'll see you in the next analysis. This report is for informational purposes only and is not investment advice. Markets carry risk of loss.